I'm Cam McClellan.
And I'm Al Lewison.
I want to talk today about lifestyle, the impact investing has to people's lifestyle. I think this is the main reason people don't invest, or one of their biggest fears is by investing it costs you money potentially to hold a property or to build a portfolio, and that impacts the lifestyle.
Oh, I like going on holidays, I like going to restaurants, I want good things for my kids, I can't invest.
Yeah. I know Felicity, when we started investing, and we didn't have a lot of money back then, so what little money we didn't have, about going out the odd time to the pub, that sort of thing, she knew that would be impacted. We were 20 years old at the time, but...
Oh, and I remember making that decision early, not just the first one, maybe the second one and so on. You think, I'm living a good life here. Is that going to impact it? Will that change? And there's things you can do.
Yeah.
I think that's the most important thing people need to be aware of. There's things you can do.
Yeah, so I want to talk a little bit today about the taxation manoeuvres you can make without making it data boring, but so people have an understanding of what negative gearing is, how they can use tax variations, some of the costs and things you can offset, so people have a really clear understanding of what it could cost to hold a property and how you can build a portfolio without impacting your lifestyle.
Yeah, absolutely. I mean, I think you touched on a few of them there, but maybe we start with tax depreciation schedules.
Yep.
So pretty non-sexy really, and the concept of it is you get a quantity surveyor into your property after your property's new, and they'll do an assessment on what all the fixtures and fittings cost versus what the building costs. And the reason for that, you can deduct them at different periods over time. So the fixtures and fittings, first 10 years get deducted pretty rapidly, and the building depreciated over 40 years. Now, why is that important? Well, it's important because that all adds up to what your tax deduction on the property is and how much money you get back at tax time.
Yeah, so if we give a really simple explanation of negative gearing, so if a property costs $50,000 to hold it, I get $40,000 in income, and I've got $10,000 loss there.
So the $50,000 holding, it's what, like paying your interest bill?
Paying your interest bill, paying all the
repairs, whatever.
Repairs, maintenance, whatever it might be.
Yeah.
If I'm earning $100,000, that $10,000 difference between holding costs and I can take that and reduce my $100,000 taxable income to $90,000 and pay tax on $90,000.
Yeah.
So I'm actually paying less tax by holding onto a property. So the government give you a benefit for buying investment property and helping out with the rental crisis.
Yeah, a really important one there as well is a new property versus an old property. So you want to control your budget, you want to control your cash flow so that you can live the lifestyle you want. The last thing you want is to move into a money pit that immediately starts costing you a heap of money, versus a brand new property that's unlikely to have a lot of maintenance issues in the first few years. Remember that house I lived in Percival Street?
I thought you were going to say Percival Street. Yeah, what a shithole.
Multiple stories there, and I'll probably tell you a couple of them, don't want to bore you. When I first bought the property, carpeted lounge room, big cathedral ceilings.
No doors on any of the bedrooms?
No, just curtains on the bedrooms.
And the lounge rooms?
And the lounge room, and a full jacuzzi on the carpet in the middle of the lounge room. Should have been some alarm bells at that point.
Swingers.
Well, I probably worked out I already bought it. I went to the final inspection, and the lady's walking around, showing me around the house like this.
Feels good.
Yeah. And then after I moved in, we'd get random knocks on the door late at night from people saying, oh, is Janine here? No, Janine's long gone. So that's not the point of the story. The point of the story is...
Good story, basically.
That the house was very run down, like very run down. It cost me an absolute fortune in bills, maintenance, things like that. Not just replacing doors, the curtains with doors, but all sorts of things started happening. One of the worst ones was a little friendly possum that we couldn't work out how it got in the house, but I wake up at night and we sit on the curtain rail in my bedroom. Just sitting up there, just running around the house, full run of the house. I would have spent $5,000 on different possum men, different treatments trying to get rid of this thing. It just kept coming back. But that is a tax deduction because I spent $5,000 on repairs.
So you obviously then rented that property out and were able to claim some of those costs as a
Correct.
tax deduction.
Absolutely.
When you fixed up the property, when you were not living in it.
That's right. Yeah, there's a crossover period.
Yeah. So the example you're providing there is an old property, an existing property, costs a huge amount in repairs and maintenance, and while you can use those to reduce your taxable income, it's still costs you shouldn't have to have.
Absolutely.
Whereas buying a new property, you get less maintenance, but the deemed value of the property depreciates over a 40-year lifespan. The tax ATO deemed that after a 40-year period that the building is theoretically worth nothing, but in the first few years it reduces and the deductions are able to be claimed at a much higher rate. So in the first few years of a property, if you're putting in a 10% deposit to buy a property, you may have to chip in $100 a week to hold that property, because your depreciations are so great in those first few years. Now, after 3, 4, 5 years, the rental price has gone up, so the property becomes cash flow positive. So by buying a new property and using the depreciation schedule to reduce your taxable income, you don't impact your lifestyle. I think that's what it comes down to.
Correct. But what if I can't afford to pay these things and wait the whole year to get it back in my tax return?
All right, you get a really boring form called a tax withholding variation form, which is Form 22. People might know who run a company car or a lease car, they can use that because that's a work vehicle. So it's an asset which is designed to impact your earnings, so you can therefore offset it against your taxable income. Same as the investment property. It's an asset designed to create income for you. So with an investment property, you can offset it. So that $10,000, like I said, the amount that your accountant will work out that you need to pay less in tax, you provide that form through your accountant to your workplace, tax withholding variation, and your workplace on a weekly basis takes less tax out of your pay and puts more in your back pocket, which helps with the offsetting.
To me, that's the clincher. That keeps your lifestyle going. Let you have your holidays, go to restaurants.
Yeah.
You're not spending this money all year, getting it back once a year and going, oh, yippee, on Tenslotto.
Yeah.
You've had it the whole way through, so you can afford to have that lifestyle that we talked about before.
Yeah. So you have the tax variation form. I think when it comes to finding the right accountant, it's really important. I always talk about accountants as if they're probably similar to doctors. A lot of people just think accountants and put a broad brush over it. You and I have gone through, how many accountants you reckon over the years?
A lot of them crying in the corner from just the repeated questioning of our stupidity, trying to understand those things.
Yeah, when we were younger, we spent probably millions of dollars, really. Different accountants just dragging the information out of them, asking the same question, like you said, over and over again until we finally understood it in a simplified version. And once we outgrew that accountant, we'd move on to another accountant. Now, not taking away anything accountants do, they've got a really important role. We've got a team of accountants who work full time for us, and I employ multiple external accounting firms for different businesses. But accountants are very different. So, like doctors, you wouldn't let a foot doctor operate on your eyes.
I was waiting for the foot. I was waiting for the foot angle to come.
It's the one that gets people and really opens their eyes up enough. So, you know yourself, the amount of times, and we had one accountant who forgot to put in our depreciation schedule in our account, in our tax return. That was the last time we ever did our tax returns. But you can see that some accountants who may be good for PAYG or business accountants don't understand how to
operate on feet.
Exactly right. Or sort out property portfolios. So find a good accountant who understands. In My 4-Year-Old The Property Investor, the book you can grab from opencorp.com.au, there's a check sheet in there which tells you how to select the right accountant. So you can go through that. It also goes into details about all of the deductions you can have. So there's a check sheet on there which lets you know what deductions you can make. People often get hung up with investors and think, rich people use negative gearing to better their life, and it's the rich people who are taking advantage of it. The Australian Bureau of Statistics, which is a terrible website, it's got a good search function in there, but show that about 90% of investors who utilise negative gearing earn on average around $87,000. So we're talking teachers and nurses and normal real people.
The average Joe.
Yeah, exactly right. So rich people don't use negative gearing because their portfolios are cash flow positive. So for people who are new to property investing and hear the term negative gearing and think that's a loophole that rich people use, it's not. That's what average Australians use to hold a property while their property's going up in value and the rent's going up in value to hold itself, so that they don't have to impact their lifestyle.
So we talked depreciation before. We talked about fixtures and fittings depreciating quicker. Buildings up to 40 years. There's things you need to do when you've got a tenant in your property at times. Like if you need to repair something, that's deductible. A bit of something I've got caught out with before is if you upgrade something, that's not deductible. Just be a bit cautious what you call in things as you're putting them through. This is probably the key one there. Cam's renowned for his famous McClellan Reno, which are just really maintenance and repairs on a property. I think is the best way to put those. Floor was ruined, need a repair. That type of thing.
So you're not improving, you're not upgrading things, you're repairing.
You're repairing. Correct. Yep.
Is the key to it. So when it comes to investing in property and working out your tax variation, there seems like a lot of things we've gone through today. An accountant should be able to handle it, but a property investment analysis should have all those things listed in there, depreciation report, which will allow you to clearly understand the set dollar amount out of your back pocket each week.
Yep. Your tax withholding form,
Yeah.
key one, and then you can live the lifestyle you want to live.
Happy days.
Beautiful.